Good evening, ladies and gentlemen. Welcome to our weekly investor update. I'm your host, Dan Theok, Senior Vice President of Investment Banking. We're happy to bring you yet another episode. And today we'll be focusing on Main Event Entertainment Group and Scotia Group Jamaica Limited. Justin Scott will be joining me on the panel. Welcome, Justin.
Thanks, Dan.
As usual, don't forget to subscribe to our YouTube channel if you like the content. Also hit the bell to stay up to date with the channel. We upload content like this just about every week. Also, if you want to embark on your very first investment journey, you should take that first step with Mayberry. Follow us on social media to learn more about how you can get started today. As promised, we'll be looking at Main Event Entertainment Group and Scotia. But up first, MEEG. Justin, what do you have for us?
So for those who don't know, the Main Event Group is one of the main event organizers and managers that we have here in Jamaica. They sort out the events, decor, audio and visual, and all things to do with the promotion that are attached to the entire event aspect. If we take a look at their revenues, for the first quarter ended January 2023, they did $626 million compared to $201 million same period last year, a 211% increase in revenues. Gross profits are also up 296%, moving from $78 million to $312 million. They typically have around a 48 to 50% gross profit line, and then we'll get further down into their operating profits. It's where it starts to dip down, as you can expect for a labor-intensive company such as this one, where the operating profit has increased all the way up to $132 million from a loss of $37 million from January 2022. Net profits are also up to $117 million from a loss of $40 million in January 2022, and providing a earnings per share of 39 cents, put forward about $1.30 earnings per share, right? So Main Event doing really well since recently, as the events from 2020, when they had a bit of a lull in terms of events organized, as people were really out and about, it's a foregone conclusion. They are back, they are better, and they are eyeing forward to do all the other great things and expand their operations as best as possible. I believe that with continued pace like this, they can end up above the $2 billion in top line per year, which would put them squarely above where they were in 2019, which was their best year prior. As the 2023 first quarter is their second best quarter since inception. Let's take a look at the balance sheet. So the balance sheet has increased 42%, up to $1.1 billion from $824 million. Total equity is up as a result of the increase in net profit from $509 million to $788 million, and the liabilities as well have increased from $350 million to $385 million. It's a very low debt company, only having about $60 million in terms of their debt, and only just over $100 million in terms of share capital. So this is a low debt company with a lot of room to grow in the event that they do intend to come back to market, which I personally would love to see, and I'll get back to that a little bit later. Let's look at the key statistics. Current share price is about $14.69 with a PE ratio of about 14 times, which is a bit below the junior market average of 18 times, and which is roughly around their 14-week high, because I expect that people would have been seeing the increased numbers come up, and that with the anticipation of the next quarter would have the involvement of the Easter events that took place across the second quarter this year, and further anticipation of all the events that are planning to take place this summer. So anywhere you had planned to go this summer, anywhere you had thought to go, or your friends talking about, Main Event may just have a hand in that pot, right? Let's take a look at the second slide, where you can see the quarterly profit movements. It has been a bit up and down over the course of the last 4 or 5 years, especially in 2020, as you can imagine. But since about the third quarter 2022, they've begun to get back to that $20 million baseline from the third quarter, and have been consistently increasing more and more as events have continued to come back in swing. As a matter of fact, a brief bit of statistics, 6 weeks, only in a 6-week period in December to early January, there are almost 2,000 events that have been booked. Well, 2,000 event permits have been distributed over the course of a 6-week period in December, just to give you an idea of just how many events take place in Jamaica on an average basis. Now, Main Event may not be servicing all of them, but you can imagine they may always be there in the best and high performance events. On the third slide, you can see how the share price has been moving to take advantage of that. From about November, December, it has begun to trail upwards from about the $8, $9 mark. heading all the way up to $14, and it is still below junior market average PE. And you can expect that, once they continue to churn out all these great quarters, continue to increase their production, really step into the niche spaces, then you can expect that main events will continue to push forward, right? The more outdoor events, the more events that they have planned, the more high-profile events like Sumfest and all these other great name ones, as you can imagine. Even the Michael Bolton event recently, you can expect that main event will be there and they will be profiting from it. Dan, anything you'd like to say on this one?
Thanks, Justin. I think we're aligned. Really excited to see second quarter results coming out. I think that those should be coming out pretty soon. There's no doubt, based on their performance in the first quarter, $118 million profit, with trailing earnings only being $309 million, that they can grow their trailing earnings by about 30%. So it's already trading cheap at 14 times. If those results come out, and I expect them to come out, and for them to do at least $100 million in profitability for the quarter, because the Easter quarter is a big quarter as well too, and then we got the summer quarter coming after that. This is a stock that's headed for at least $18 in my view in the upcoming months, and it's hard to bet against Solo and his team. Great management over there. They really know how to execute, and Jamaica is just busting at the seams to have lots more parties, and I think it's going to be a great summer. So look out for the results, folks, coming out, I think, within the next day or two. I think they're going to be great. I'm going to predict $100 million in profitability minimum, and we're going to watch the stock price go to at least $18 in the next quarter. So this one's definitely a buy for me, and you guys should go and get this out.
Absolutely, man. And that's $100 million per quarter. I almost forgot to bring it back to it. So that $100 million in shareholder capital leaves them a lot more room to grow if they decide to come to the market for additional equity. So they have the space to raise about another $400 million before they hit that $500 million shareholder capital ceiling at this point. And they do still have another 5 years of the 50% tax break at this current point. So personally, I would love to see Main Event go forward and do something like actually invest the money, whether by equity, strictly by equity, or even go further for a bigger venue, and to actually purchase a venue to then further rent out to promoters going forward. I mean, that way you're literally developing an entertainment space, which we don't have a whole lot of in Jamaica, that will then now funnel directly into your business that you can then provide the services for. So that would be great for them, whether just strictly by equity, or if they want to go to bigger route, they can do equity and debt to go that forward. As I said, it's a very low debt business, so they do have the space to do so.
Okay, thanks for that. Well, we're looking out for bigger and better things from Main Event. Solo, congratulations to you and the team on the great turnaround in the past year, and I think they will continue to do well, folks. Let's see where the stock price heads to later on in the year. Okay, up next, we want to look at Scotia Group Jamaica Limited. Talking about turnarounds, here's another great story, and I'm really excited to jump into looking at their results for the half year ended April 2023. Starting with the net interest income, we can see that's up by 39% to $18 billion. Expected credit losses are down by 4%, and Scotia being the conservative bank that they are, their loan portfolio has less than 2% in non-performing loans. So they've done a very good job. This is a $249 billion loan book, folks, which they've grown by $40 billion in the last year as well too, and keeping their expected credit losses down. Interestingly, Justin, I see them noting that mortgages are up 31%, mortgage loans, commercial loans are up 20%, and retail loans only up 12%. So, good going there, guys. It's good to see them growing their debt book in this high interest rate regime, and that all goes well for their bottom line. Insurance income up a whopping 600% from $135 million to $1 billion. So they're doing really well in the insurance segment. We note this is their 25th year in the space. They've made some adjustment, brought some new products. They talked about innovation in critical illness and so on, and that's paid super fruits to them. We also take note of their early adoption of the IFRS standard, which deals with insurance contracts, and they made note in their results of bringing onto balance sheet equity-linked contracts and things like that. So they've done a full restatement in terms of accounting under IFRS 17, which is good because that's making a lot of people nervous to understand how IFRS 17 is going to affect companies with large insurance segments. And in the case of Scotia, we're taking note that insurance is now a large segment of the business. Moving further down, we see total operating expenses up 11% to $14 billion, and that's associated with the higher volume of transactions that they're doing and the associated tech support cost for those fees. So not too worried there. If you grow your top line by 39%, you're obviously going to have to grow your operating expenses. You put that all together and we see their profit before taxation up a whopping 100% to $11.3 billion. And we take note in terms of segment reporting that insurance now represents, insurance and related profits now represent about 20% of their profitability before tax, $2 billion. And 50% comes from corporate and commercial services. They do very little in the investment banking space, maybe $1 billion. And Treasury also generates about $1 billion of profitability. Take out your taxation, and the net result is a net profit after tax and attributable to shareholders of $7.6 billion for the half year, up 108% over the previous year, which is impressive by any standard. Looking at the key statistics, we can see the share price is at $34.70. That's a PE of only 6.9 times, which means it's 30% undervalued by the main market average of 10 times. And when you consider the growth that's recently come through and the potential for that to continue, this is definitely a good time to be buying Scotia. I bought it 5 years ago at $50. Got frustrated with them after 2 years, sold it back at $50, and now I'm ready to buy again. I think $50 is definitely on the table for them in the next year or two as interest rates start to come back down. Looking at the balance sheet, we can see that total assets are up 5% to $633 billion. To note, they also grew their deposits substantially over the period to $438 billion. And this is another reason why I don't believe the Bank of Jamaica's high interest rate regime is going to last much longer, because the banks are just making bigger profits, quite frankly. They're not increasing loan rates. They're just making a lot more money out of their treasury by buying Bank of Jamaica CDs and making 8% on 90 days and passing over 1 or 2% to their customers in the form of deposits. So the banks are going to make more profits under this regime. But $438 billion in deposits, I mean, that's second only to NCB, of course, who probably has $600 billion in deposits. But Scotia is just perceived to be a super safe bank. Right. And so in these times, folks sort of, go to these type of banks, not to mention the stories of SSL and whatnot. And so Scotia's, second largest bank by balance sheet. And in terms of market cap at $107 billion, really hard to get against the Anya Schnorr-led board. And we are happy to see Anya coming back and being involved. She is brilliant, and Scotia's got a great board lined up. So again, total assets up to $633 billion, and that's composed of about $249 billion in loans, which are up by 20% or $40 billion, $181 billion in cash. This bank is rock solid, meets all of their regulatory requirements and reserves and adequacy tests by a mile. They have $150 billion in investment securities, and that pretty much makes up the balance sheet. The only thing I wasn't in love with is the defined benefit asset, and this is my pet peeve. I'm not a big fan of defined benefit obligations. This is where the company bears the risk of the performance of the pension fund, and the pension benefits are not tied to the contributions of the staff, but rather their salaries and years of service. That's a defined benefit obligation. So, Anya, my one word of advice is to try to move away from the defined benefit obligation if you can for new staff, and move towards a defined contribution plan. Why am I saying this? We've seen in this high interest rate regime, the obligations of the defined benefit overtaking the pace of growth in the assets. And the net result is their defined benefit asset, which was once $31 billion just a little over a year ago, is now down to $15 billion. Still not significant enough to move the needle, turn me off of it. It's just my pet peeve. I don't like to see defined benefit obligations, because it means the company fundamentally takes the risk of performance of the assets for the pension, the staff and the pensioners. So fundamentally, I'm against defined benefit obligations, big find in the DC plan. And it's the number one reason why, for instance, when you look at shareholders' equity, you see overall shareholders' equity falling by 3%. And you ask yourself, how does the shareholders' equity fall when they just made $7 billion in profit? It's because running through OCI is a $6 billion loss on the defined benefit obligation asset, and they paid $1.8 billion in dividends. So that explains a small drop in shareholders' equity, despite the $7 billion of profit, which is 108% growth, is driven by the combination of the defined benefit obligation that was marked down through OCI by over $6 billion and the $1.8 billion in dividends. Speaking of dividends, it's great to see Scotia being very consistent with dividends. On June 8th, they again declared a 35-cent dividend, which annualizes to a dividend yield of 4%. So unlike NCB that isn't paying dividends yet, I think that'll change by year end. Scotia has been paying dividends consistently at about 35 cents per quarter over the last sets of quarters, and that's great to see. And so for those of you who've got Scotia, you're going to be getting some good dividends coming up. All in all, I really like the company. I like the direction. Love the board. Big fan of Anna Schnorr. I think Audrey is coming into her own as CEO of the bank. We're seeing great things happening. I hope to continue to see them continue to do well, even when interest rates start to come back down over the next 4 to 6 months. But I think at $35, it's a great buy, 7 times PE. One of the cheapest blue chip main market stocks out there, where the main market average, as I said, is 10 times. So it's a great buy. Next slide shows you what's going on with profitability. Again, very few companies, 4 quarters in a row, trending $3 to $4 billion in profitability. So, they're obviously back and doing exceptionally well. I expect this trend to continue. And for that reason, I think the stock can be at $50 in the next 12 months. Next slide shows, by contrast, stock price has been pretty stagnant, right? Hasn't moved much in the last 2 years, trending around $35, $36. Again, coming from, $52 2 years ago. So it's, pretty much trading at a 2-3 year low. And a lot of stocks out there are trading at a bit of a low, NCB included at $70, super good buy as well too. So from my point of view, hard to bet against NCB and Scotia. They're the 2 best buys I think that are out there right now. Hard to be a serious long-term investor and not have both of them in your top 10 for long-term purposes. I think there's a great buy opportunity for Scotia at this PE. Justin, what do you think?
Yeah, great points, Dan. Definitely Scotia has been doing exceptionally well over the last few quarters. I do want to bring Mark over because last time we spoke on Scotia, they were below their book value per share. Yeah. And once again, here we are again, still below book value per share. And as they continue to eke out greater and greater profits, and as I said, with the defined benefits, once that starts to trend back closer towards or at least reduce the amount of losses or the impact that it has on the OCI, we can expect them to have greater contribution towards their shareholder equity, which only will further reduce it. So I'm expecting good things out of them as a company. Scotia definitely has a lot more further to go, and as interest rates continue along this path, they will only continue to rake in these kind of profits. So good on them.
Yep, absolutely. And great point on the price to book. How can it be trading below its price to book? It should be at minimum 1.3 times. So 2-3 different ways for me to demonstrate that it's undervalued by 20 to 30%. And I think we're going to only see them come into their own as time goes on. So thanks for that. I think we're aligned both on MEEG and Scotia Group Jamaica Limited. That's all the time we have for today's discussion. I'd like to give a big thanks for you guys for tuning in, and for Justin for your insights as usual, which we always appreciate.
Pleasure as always.
If you're curious about updates on our virtual investor forum, then find us on social media. We share our live stream dates and our upcoming guests on our official social media pages. So give us a follow-up and stay on top of all things forum related. And also don't forget to subscribe to our YouTube channel, Mayberry Investments Limited, and click the bell to receive all of our notifications. Well, remember folks, keep safe, and wise investors, slow and steady wins the race. Goodbye.